All right, looks like we're all here. So here's where we're going. Now, we're not quite done with chapter 9. We will finish that today, and then we'll start chapter 10, which is a very different topic. It's an area that really sort of overlaps with finance more than anything else. So let's take a look at 9 and just remind ourselves where we were. We were talking about, in the beginning of this chapter, economic growth, and we we're looking at real economic or real GDP growth, as well as real per capita GDP growth, which we assume is the best possible measure of how our standards of living are changing over time. And we then introduced the concept of potential real GDP, which simply refers to a situation where no resources are being wasted, which specifically means that there's no cyclical unemployment. So when we've reached that point, we're at what we call full employment. And of course, full employment doesn't mean zero unemployment. It just means there's no cyclical unemployment. There's probably still going to be structural and frictional no matter what we do. But the one thing that policymakers can try to control is cyclical unemployment. And when that's been eliminated, we've reached what we will call potential real GDP. All right, now the labor market. We saw that labor, like any other good in the marketplace, can be explained by supply and demand. And of course, we noticed that in this case, we're thinking specifically about real wages rather than nominal wages, because this refers to how much we can actually buy with our wages rather than how many dollars we're getting paid. So the incentive to work really depends not so much on the nominal wage rate, but the real wage rate, meaning how much purchasing power will we earn for every hour that we work. Now you can see we have the demand curve right here, which we're calling LD. And as you can imagine, the real wage, the demand, which by the way is coming from typically businesses, but not always, sometimes government as well. But the bottom line here is that the more expensive wages labor is, of course, fewer workers will be hired when wages are very high. As the real wage drops, the quantity demanded of labor will rise, just like the demand for any other good. Now, on the other hand, the supply of labor is coming from individuals who choose whether or not to work. Of course, every person has to decide how much they're willing to work. And that decision ultimately comes down to the real wage. How am I being compensated for giving up my free time? Because when you work, of course, you give up your free time. So there's a steep opportunity cost there. The question is whether or not the real wage that you earn is enough to compensate you for that opportunity cost. So naturally enough, as the real wage rises, people will work more and more hours because the value is so much higher than the opportunity costs of the sacrificed leisure time. And then we can bring these together to determine the equilibrium real wage as well as the the quantity of labor. And we also want to ask ourselves some important questions about what is it that causes potential real GDP to grow over time? In other words, how are standards of living growing over time? Well, economists cite two main factors here. Number one, increases in the supply of labor, and number two, increases in the productivity of labor. If we have more workers available to us, well, then clearly more hours will be worked, more output will be produced, and standards of living will have to rise. All right, so in other words, each individual worker can work more hours. There can simply be more people in the population in general who are eligible to work. That type of thing can cause an increase in the supply of labor. And when we saw in the diagram, if there is a supply increase, though, unfortunately, the real wage starts to drop as a result of this. But if more people are available to work, then the supply grows and the real wage starts to drop, as long as assuming that there's no change in the demand for labor, of course. On the production possibilities frontier here, when this happens, when the supply increases, there's been no change in productivity. We're simply moving up the same curve. All right, so in other words, more quantity of labor is being employed. As a result, real output will grow as well. It has to. As long as more people are working, more output will be automatically produced. Productivity, though, is very different because productivity means that we are squeezing more out of our existing resources. So productivity grows, we can have more output without hiring more labor. So when labor becomes more productive, for whatever reason, it could be because workers are gaining more experience. It could be because they have more and better training. It could be that they have better education. The entire curve will shift up to indicate that even at full employment, more output can be produced if we have a more productive workforce. So productivity is something that's closely followed by economists. And I think we may have looked at Fred to see how productivity is doing in the United States. Let's just check this out one more time. Fred, of course, is our go-to database for economic data. As you all know by heart by now, Fred stands for the Federal Reserve Economic Database, and it is implemented by the Federal Reserve Bank of St. Louis. And in a later chapter, we'll spend a great deal of time studying the Federal Reserve System. But for now, we'll just note that this is coming from the St. Louis Fed, and they have data about just about everything you could possibly imagine, and it's all free. All right, let's see. This is real output per hour. Of all persons, non-farm. Often they make it in the economic data produced by the government. Often they leave out farming because it's a very different sector of the economy than all the rest. In other words, they feel that it's so different that what they would like to ideally do is isolate out the impact of farming, and this represents the rest of the economy. And you can see that going back to the 50s, it's been growing very, very steadily. In fact, there's hardly any dips up and down like you would get with GDP itself. And so if you look at these numbers, and by the way, the index is based on the year 2012. So that means, where is it? Right about here. In the year 2012, the output per hour per worker is set equal to 100 so that you can tell where we stand in all these other years. So right now, it's at about 112.287, which means real output per hour has grown by roughly 12% since the base year in 2012. But that means in all previous years, it would be less than 100. And in fact, if you go back to the 50s, late 40s, 50s, you can see it's only around 25. So that means that between 1950 and now, 70 years later, real output has grown from about 25 to about 112. Let's see what that represents in terms of percentages. Let's see, hold on one second. Okay, according to my calculations, output per hour has gone up by about 348% since the 50s. Now, on an annual basis, that works out to roughly 1.8% per year. Now, that doesn't sound like a lot. Yes, technology is a very major part of that. In fact, if you look at the curve very closely, you'll see that it seems to be getting a little steeper in recent years, and you can rest assured that technology is a major component of that. Technology definitely increases output, and that means that our standards of living are rising. And it's not just technology. It also has to do with the amount of capital that we have available to us, the quality of the capital, all the machinery and the equipment and the buildings that we have, and the cars and the trucks, and you name it. Whatever we're using to produce goods and services is becoming more efficient over time. But we're also acquiring more total capital, not just better capital, but more total to produce goods and services. So all of that combines to produce more and more output every year. And so naturally enough, this translates into a higher standard of living. Okay, so in fact, if you were to plot this side by side with real GDP, you would see that they pretty much parallel each other. All right, well, anyway, so that's why this curve is shifting up, to indicate that more output can be produced even with the same amount of labor because of improvements in productivity. Now, if in addition we have more labor, now higher productivity means that businesses can afford to hire more workers because they're adding more to the bottom line. Okay, in other words, it's more profitable to hire workers when their productivity rises. So that will cause an increase in the real wage, and it will also increase the number of people who are working. So you can see productivity is incredibly important in determining how well we're doing, because it determines our real wages as well as how many people actually get to work. Anyway, so what that means then is that in addition to the curve shifting up, if we're hiring more workers, more output will be produced along the higher curve. So you're getting more bang for your buck this way. Because productivity is rising, we get two effects. First, the entire curve shifts up, and then we move along the curve because more workers are being hired. So we're really gaining a great deal because of that increase in productivity. So that's the bottom line, productivity. And of course, technology keeps advancing. Also, a lot of innovation. Entrepreneurs keep producing more and better products. And so, if anything, the trend seems to be accelerating, that more and more nice, fun, new products come available to us all the time. And we are, of course, the primary beneficiaries of that. But it also, you notice how in the recent years, you've seen a rising trend of billionaires who are still in their 20s because they've invented some new product that everybody wants, and they've made themselves very well off as a result. Okay, so anyway, the next thing we want to consider, is what actually causes this. Increases, as I said, in human capital and improving technology. In other words, more education, better training, more experience, but also just plain savings and investment. If people save more, more can be invested in improving our physical capital. All right, so that is an important component of this. It's not just the advances in technology, it's not just the improvements in human capital, it's also increases in the amount that we save and make available for investment in physical capital. Okay, so in other words, if a company updates its equipment so that the workers can produce more, that is what we mean by investment. And that happens all the time. I mean, if you'll discover this one day. No matter where you work, you'll almost certainly have your own computer, and it'll be an interesting question to see how old your computer is. At some companies, they may keep the same old computers for several years. Others will update them very quickly, and that will help determine how much you can produce on the job. All right. Savings, of course, with more savings, more investment becomes possible. And of course, with more investment, we have more capital to work with, and so productivity rises. Okay, so it's like with a farm. The more capital we have, the more machines can do the work that used to be done by people. And of course, with farming, to do all that by hand would require enormous amounts of physical labor, whereas with capital, of course, it takes the place of many, many people, and therefore increases our productivity quite considerably. All right, so of course, yes. So as firms continue to update their equipment, especially computer equipment, they can increase everybody's productivity as a result. So more capital means higher productivity typically. Sadly, though, this can't continue forever. In fact, if you notice, this curve is sloping upward, but it's sort of increasing at a decreasing rate. That's because even here, we're going to eventually experience diminishing returns. In other words, if we double the amount of capital that we have available to us, it doesn't necessarily mean that we can double our output. We do have diminishing returns, even here. So that, unfortunately, yes, even rising physical capital will typically increase the amount that we can produce, but maybe not by the same proportion. So like I said, if we double our physical capital, it may not be enough to double our output. But still, it's worth trying, isn't it? The more capital we have, the more output should grow, but maybe not as rapidly as it did when we had less capital. In fact, this is the whole point of some of those videos we saw, where growth is much higher in countries that have very little capital, like Germany and Japan after World War II. Their capital stocks had basically been destroyed, and they were starting from scratch. So their growth rates were quite high compared to the Western Europe and the United States. Okay, now this one is pretty straightforward. More education, more training. People go, let's say people go back to school and get more advanced degrees. The company provides them with training. They learn on the job, that kind of thing. I still never did find out what the book means by lifestyle choices. I have to go double check that. I assume that they mean that people end up voluntarily saving more of their income and then spending less so that more investment can take place. But it's not clear from the way it's written here. And of course, technology is the ultimate driver of productivity because, like, for example, if you look at how fast computer chips are now compared to even 5 or 10 years ago, it makes a staggering amount of difference. It really does. And in fact, this type of technology is going on behind the scenes in a lot of the products that we use every day, like even iPhones, for example. It has to have memory chips in it to do what it does. And the faster those chips are, the more sophisticated our phones can be, and the more useful things we can do with them. Like, for example, and here's another example, Google Maps. If you've ever used Google Maps, what exactly is going on? You type in an address and it says, all right, well, if you want to get there from where you are, here's what you do. And as you're walking or driving, it continues to update itself and tells you, well, if you go up here and turn right, that would be a good idea. Where's that information coming from? Satellites. And where did satellites come from? That's what we mean by capital investment, satellites. If nobody had ever put satellites up in space, we wouldn't have this kind of technology. So the technology feeds on itself. The more advanced the technology is, the more new clever ways we find to use it, and the more rapidly productivity grows. Okay, so if you've ever been lost, you know how well Google Maps works. All right, so it is a very good product, but it's made possible by the computer chips and by the existence of those satellites. All right. Oh, here we go. So theories of growth. Now we have spent a certain amount of time on trying to understand the different schools of economic thought. They all had something to say about just about every aspect of economics. And we know that, for example, the classical economists were very opposed to letting government intervene in the marketplace because they felt that the economy would always correct itself if anything went wrong. So the classical economists also had their own ideas about what drives growth. And then we also have this other area called the neo or new growth theory. Now, classical growth theory, this is interesting. In fact, maybe we could find a video about this one of these days. If you've never heard of this before, Malthus, Thomas Malthus was actually a minister who lived in the 18th century. And he wrote in his writings, he explained to the world how the world would always live in miserable poverty because, in his ideas, the population would always grow more quickly than the supply of food. So he was thinking that even if a society appears to be prosperous, that prosperity will encourage people to have lots of children, and that population growth will exceed our ability to grow food for them. And so gradually our standards of living would drop, and that eventually in the long run, we'd all be living at what he called a subsistence level, meaning that we'd all just barely have enough to eat, and that would be about it. So it was a very, very gloomy outlook, very gloomy. And you may see the word Malthusian thrown around as an adjective in different articles that you might be reading. And they're referring to this very gloomy theory by Malthus that the population growth would always outstrip productivity growth. So therefore, everybody would always end up living in misery and poverty. Now, what was the fatal flaw, do you think, with his argument? I mean, obviously he was wrong because, look at the way we live now. Do we live in misery and poverty? No, of course not. What exactly was wrong with his theory? What was the biggest problem with his ideas?
More people,
Right.
more productivity for food.
Exactly. He had no way, at the time he was living, productivity grew very, very slowly, including in farming. I mean, farming didn't change a whole lot from the 17th to the 18th century. People were still out there with antiquated equipment, doing everything by hand, and he had no reason to think that that would ever change. So, in other words, once the Industrial Revolution really got going, all of a sudden, all this new machinery became available, and that dramatically increased productivity, especially in farming. And so, as a result, suddenly farming productivity is growing much, much faster than the population. And so as a result, humans were able to live at a progressively higher standard of living. So in other words, the fallacy of his thinking was that everything in the future would continue to look like it did in the 18th century. It never occurred to him that productivity could increase in the future because based on his experience at that point in time, that was probably not a terrible assumption. Because let's face it, up to that point in history, farming had changed very, very little for hundreds and thousands of years. Well, so his writings were very widely read, and he gained quite a reputation as a doom and gloom guy. But fairly soon after this, it became clear that what he was saying was probably not right. Again, because the Industrial Revolution showed that productivity can grow very quickly under the right circumstances. Okay, so yeah, I mean, basically you're saying no matter how much we grow, the population will grow even faster and therefore we'll never get ahead. We'll always end up in subsistence. Now, the neo-growth theory says, oh no, Malthus, you were crazy to say that, because technology and rising productivity will not only increase growth, but it'll increase at a rapidly rising rate. So therefore, real GDP will be able to grow much more quickly than the population. And so in other words, real GDP per capita would rise even with a rapidly rising population. Also, you know, I was thinking too, another reason why he was maybe not forecasting very accurately, at this point in history, when almost everybody worked on farms, families tended to be very large because realistically, if you're a farming family, you need a lot of children to help do all the work. And so it wasn't uncommon to have enormous families at this point in time. And he felt that that would also continue into the future, not realizing that once productivity started to grow, population growth would actually shrink. And so, of course, standards of living could grow very quickly. Now, if you look, I don't know if I have access to this right now, but if you look at how quickly standards of living have risen over history, and I don't mean just the 20th century, I mean going way, way back, you'll find that standards of living grew like almost not at all for hundreds and hundreds of years. And then only at the very end, within the last 150, 200 years, has growth started to really accelerate. In fact, you know what, let me see if I can find a graph like that. Graph of standards of living growth going back to, let's say, the Middle Ages. I've seen these graphs before, and I just I'm not sure if I can find one off the top of my head. Maybe this is it. Let's see what we've got here. All charts in economic growth. Let's see how far back they can take us. GDP per capita from 1500. Oh, oh no. Oh, here we go. Well, this is pretty much what I was hoping to find. Look at this. Oh boy. Okay, I don't know if you can see this. These are, well, there's different countries. Oh boy, why are these? I was hoping to find the United States, but even for these countries, not exactly the wealthiest countries in the world, their standards of living grew very slowly. And then when did they start really realistically turning up? Around the 1950s, and then since then they've been growing very quickly. Man, I thought I could do something. Well, this is the world. Let's try this one. Ah, it's a paper.
I think you could go to the same one and then plug in table and then they'll show you the countries.
Maybe. Let's find out. I hope so. I want to see the U.S. Of course, with the U.S., the history doesn't. Oh, here's England. Oh, all right. Let's look at this one. This will do. GDP per capita in England. Now look at this. Going back to 1270, all the way up to let's say 1900. How much did it go up in those 600 plus years? Almost not at all. Zero. Look at this. Because technology is not changing, is it? No, everybody's doing the same thing they've done for hundreds of years. And then what comes along, even here in the early days of the Industrial Revolution, it didn't grow that rapidly until we got past, let's say, World War I. And all of a sudden, now when here's World War II being over, boom, look at that. How do you like that? This is real GDP per capita. Look at this. It went from in 1947, 6,700. It's basically quadrupled since, let's say, the last 80 years, after hardly rising at all for like 700 years. What is this all about? What's the magic thing what is it that was missing back here? Technology. It wasn't there. It wasn't invented. And all of a sudden, boom. Wow. That's pretty shocking to look at, don't you think? But not surprising. Is anyone surprised to see this? No, because like, again, almost everybody was working in farming where nothing changed for hundreds and hundreds of years. You could be out there in the fields doing exactly the same thing, the same equipment as your great grandfather, and nobody would have thought twice about it. So this is what happens when we have growth, which is driven by productivity, which in turn is largely driven by technology. Wow. Amazing. All right. Well, I'm happy that I found this. In fact, you know what I'm going to do? I'm going to copy this link and send it to you in case you want to explore this further. Oh, hold on. I see there's some chats going on. I don't know if that's available, the Empire. And there's that too, mercantilism. Very good point. Very little trade. As we know, Adam Smith was writing in the 1770s as a backlash against mercantilism. So that may have had a lot to do with it as well. Very little trade, if any, was taking place in those days. So of course, countries couldn't take advantage of comparative advantage. And that would be another reason why there's very little growth here. Very good point. And the empire, that certainly helped, but probably I don't know how they figured that out. We'd have to read this more closely to see how they came up with these numbers. But here they're even specifically talking about Malthus. It says here, the economy before economic growth. And wow. So there's a lot. Oh, this is good. So if you want to read this on your own, you certainly may, because there's a lot of discussion here about how this happened. So, man, this is interesting. Oh, look at this. We can add countries. Oh, what a great website this is. I didn't know this thing even existed until today. All right, let's do it. Let's get the US in there. Yeah. And of course, the US, obviously doesn't go back that far, but you can see how quickly we started to grow after the Depression was over, after World War II was over. Whoa, there's some serious growth. In fact, you know what I can do? There's Western Europe, there's all the others, and they're growing too. I mean, sure, all their growth rates increased after World War II as well, just not nearly as much. Man, wow. Well, anyway, I think, wow, this is a very interesting and exciting website. So I hope you'll explore it because they're not only showing you the charts, they're helping you to understand why this is happening, which is really the most interesting part. But it says right here, when Malthus raised the concerns about population growth in 1798, he was wrong about his time in the future, but he was right in his diagnosis of the dynamics of the past. Before he came along, that is exactly what happened in the world. Population increases were associated with declining nutrition, health, and declining incomes. After Malthus died, the world became less Malthusian. What he did not see was that the increasing output of the economy will decouple from the change of the population so that the output will increase over a long period. Okay, so in other words, it never dawned on him that something could change in the future, I guess because he'd never actually seen it happen in the real world. He figured, well, what's going on now will happen forever, and there's nothing we can do about it. Well, fortunately, he was wrong, but he really got his name out there, and everybody knows about Malthus because of this. So, and interestingly enough, he wasn't. The field of economics was still quite in its infancy in those days. Nobody would have at the time said, "Hey, you're an economist, aren't you?" He was actually an English cleric, okay, and he wrote in the fields of what they called at the time political economy. But remember, this is only a few years after Adam Smith, so the field of economics is still in its infancy. So he had a major influence on Western thinking, but it became clear fairly quickly that what he had to say was actually no longer valid. So anyway, it's all here. Ooh, I did not know about this. Malthus and Ricardo had a big debate on political economy. You can see David Ricardo was a free trader. He would have had the opposite outlook. He would have felt that trade can make countries grow very quickly, which means that Malthus's ideas would probably not be true. Interesting. Wow. That was the great debate, I guess, of the early 1800s. All right. Well, anyway, so I guess we can get back to where we were. And that would be the neo-growth. Yes. So neo-growth holds that pursuit of profits leads to increasing innovation, which brings about improving technology and productivity. Outdated and inefficient firms disappear, while newer and more efficient firms will take their place. In fact, there was an economist. Let me just toss this in here. Another interesting bit of economic history. The economist Joseph Schumpeter referred to this process as creative destruction, meaning that the inefficient old firms would be replaced by more efficient newer firms. And so, yes, things are being destroyed. Older firms are disappearing, but newer and better ones are taking their place. So as a result, we, as consumers, we all benefit from this. All right. Now, policy and growth. Now, this is starting to get more into political economy, but a lot of writers have concluded quite correctly that economic freedom and property rights are prerequisites for growth and prosperity. In fact, there's a lot of this discussion actually originally comes from Adam Smith's writing in The Wealth of Nations. But given that background, policymakers can encourage economic growth in several ways. First, the goals of this policy should be to, first of all, make as much capital available to workers as possible, to increase the amount of human capital, in other words, encourage education and training, and of course, do whatever it takes to help accelerate the speed with which technology improves. So some would suggest, for example, that companies could be given tax credits for research and development, or people could be given tax credits for getting more education. That type of thing could be done by policymakers. So we have incentives. We always need incentives to innovate, to save, to work, to acquire new skills, etc. Without those incentives, none of this ever happens. As we know from looking at throughout the world at very poor countries, almost without fail, in those countries, they have very poor legal systems. They have very inconsistent property rights. Like people can invent things without necessarily getting to keep the profits. And also we need to encourage R&D, which again is often done with tax cuts or tax breaks. We need to do whatever possible to improve education. And of course, encourage trade and specialization. All of those things have the ability to greatly increase economic growth, which in turn, of course, increases standards of living. All right. Well, this is, economic growth is a very complex area of study. As you saw in the Solow model, which, they showed us a very simple version of it, but it is a very interesting and important idea. But this is actually a very intense area of study. And in fact, economic historians spend a lot of time analyzing the conditions that led to the rise of, like the US, for example. How did it become so wealthy over time? And why did other countries fall so far behind? There's a lot of good writings in this area. In fact, there's one in particular. If you feel crazy ambitious, he wrote this book, David Landis wrote this book called The Wealth and Poverty of Nations: Why Some Are So Rich and Some Are So Poor. This is a book that's used widely in economics departments where they're teaching in a field called development economics. And what they're trying to do is isolate the factors that lead some countries to grow quickly and others not to grow so quickly. So this, if you feel like I want to read more about this, this would be a good starting point. Okay. And it's not too overwhelmingly technical either, which is kind of nice. But, it's something to think about. You've got nothing better to do during the summer, let's say. Maybe you might want to flip this open and see what's going on. Well, all right. Anyway, enough of that. So now we're ready for chapter 10, which is a very, very different chapter, because now we're moving into an area which is really, or really has a lot in common with finance. We're going to be specifically looking at financial markets and the determination of interest rates, which is a logical tie-in to what comes after that, where we will be looking at money and the Federal Reserve System. Okay, so it makes sense that we study financial markets before we move into our discussion about money and the Federal Reserve System. So let's get that out and see what that's all about. And so this is still only part one that I posted, but there's plenty of good material here. The chapter is called Finance, Saving, and Investment. So we're going to be looking at financial markets, saving, investment, and ultimately the determination of interest rates in the marketplace. Where do interest rates come from? That's a key detail, because interest rates determine the cost of borrowing, which means that if rates are very high, this would tend to discourage investment spending. But it also determines the rate of return to saving. So in other words, as individuals, we have to decide how much of our wealth to save and how much to spend. And the interest rate will determine how much we're willing to save. If rates are low, like they are now, we have a very low incentive to save because we're not getting a very high rate of return on our savings. So higher interest rates will discourage investment, but they will encourage saving. Low interest rates will do the opposite. All right, well, So we're going to start with this concept of capital. Now, capital, it's easy to get confused about this word because it's used in so many different potential ways. Here we'll make a distinction between what we'll call physical capital and financial capital. So up to this point, every time we mention the word capital, we were talking about physical capital. We have not yet started analyzing financial capital. So what is the difference between the two? Well, physical capital refers to the machinery and equipment and buildings and tools and all the rest that are used to produce consumer goods and services. So when you go into a Starbucks, and I've used this analogy before, the blenders that they're using to make the frozen drinks would be defined as physical capital, as would the machines that they use to make the espressos and the pots that are used to make the coffee. All of that is referred to as physical capital. The more capital we have, clearly the higher standards of living will be, because machines can do these tasks a lot quicker than human beings. On the other hand, financial capital refers to the funds, dollars that is, that are used by firms to acquire the physical capital, as well as run their operations on a daily basis, possibly expand into new markets, develop new products, et cetera, et cetera. In other words, the funding that a corporation needs to run its business is known as financial capital. And that holds true for small businesses too. It's not just corporations. Money is needed to run a business. And so the money that we acquire to do this is called financial capital. Now, where do we get it from? That's a separate question. Although it'll come up later on in the chapter, but typically, I'll just mention it right now. A corporation in particular can acquire funds by selling stocks, it can sell bonds, and it can borrow money from banks. It can also get funds from private investors. If you've ever seen that show, The Shark Tank, what exactly goes on in that show? Has anyone here ever seen that show?
Yes.
Yes. Okay, what happens in that show?
It's basically, if you have an idea of business, you go represent it to them, and then if they like your idea, they will take a percentage and they give you like money or guess.
That's right, exactly. Let's say you're running a business, it's working pretty well. You think it has a lot of potential, but you need money to expand. So let's say it's a lot of money, like $500,000. Well, you're not going to be able to borrow that from your parents, let's say. So instead, you approach the sharks and say, listen, I'm running this very profitable business, but I need money to expand. What do you think? And they'll either say, no, we don't like your idea, or they might say, yes, we'll give you the money, but you will have to give us, let's say, 20% of your company in exchange for that. And you have to decide if their offer is worth your while or not. But the money that they're providing you is called financial capital, or in this case, it's called venture capital, which is a special type of financial capital because it comes from individual investors, private investors, who are offering to help finance your company in exchange for a share of your company, which means a share of future profits. That can be done too, but although that typically happens in the early stages of a company's existence, later on, when the company gets big enough, even the venture capitalists won't have enough money to lend you. Like, for example, Amazon. I mean, Amazon is a massive, massive corporation. When they need money, they need a lot of money. Let's say that Amazon decides that they want to, I don't know, let's say they want to acquire another company, and the cost is $100 million. They're not going to get that from venture capitalists. For something like that, they either have to sell stocks to the public or bonds or some combination of both, because the amount involved is so large. So when you get past a certain size, even the venture capitalists are no longer enough, because they're taking that money out of their own pockets, by the way. So they can only afford to give you so much money. But when you still need massive sums of money, you can get it through either the stock market or the bond market. And the funds that you do manage to raise are called financial capital. All right, now investment. Investment here means not buying stocks and bonds. It means a company invests in its physical capital. All right. So we're talking about what is sometimes called real investment as opposed to financial investment. I'm a company, my computers that my employees are using are getting a little outdated. So I borrow the money that I need to buy them new computers. That would be defined as investment. Now, the unfortunate reality with investment, though, and they discuss this in the solo videos, is that when we have a lot of capital equipment, it does wear out over time. It loses its value. And so that process is called depreciation. Now, you've experienced this yourselves if you own a car. What happens to your car over time?
Gets old.
And what happens to its value?
Decrease.
It goes down. In other words, if you bought a car 2 years ago and you decided to sell it today, you would have to accept a lower price than what you paid for it because you put a lot of mileage on it and it's now worth less than it previously was. This happens to all physical capital. It wears out. It becomes worth less because you've used it. Also, sometimes it simply becomes obsolete. Like, I don't know if you've had enough. Has anyone here had like more than one computer in their lifetime? Have you had an older computer that you had to replace? Or have you had the same computer all along? All right. Well, all right. Imagine like, let's say when you were younger, your parents got you your first computer. And let's say that was in the year, wait a minute. You've had multiple. Okay. So somewhere along the way, let's say when you were younger, your parents bought you your first laptop and you had a lot of fun with it, but that was, let's say, 5 years ago. What has happened to that laptop in the last 5 years? The laptop itself might still work just fine, but oh, you got a virus. All right, well, that's a constant risk. But let's say yes, compared to the newer, oh yeah, that happens too. But compared to newer computers, it's not as efficient. It's not as fast. And in fact, sometimes what will happen is your old laptop may not be able to run newer software because the new software requires much more memory and speed. So even if your laptop doesn't physically depreciate, it becomes obsolete over time. And this kind of thing is still referred to as depreciation. Sorry about that. It's simply less valuable than it was when you first bought it. And that's the kind of thing that affects all physical capital. And in fact, a lot of investment spending is undertaken just to replace equipment that's been depreciating. All right, so that's why this is such a big deal, depreciation. So we have to replace our capital equipment on a pretty regular basis, especially if we're using it to run a business. The funds that we use to buy more capital are called gross investment, but when you subtract the amount by which your equipment has depreciated, then that spending becomes what we call net investment. In other words, net investment means you've invested more than enough to cover your depreciation. Hopefully, over time, that increases for the entire country. All right. So if not, if the country is in a huge slump, the economy is in very bad shape, you might actually find that net investment spending is negative, meaning that depreciation is more than new investment spending. That's a very bad sign for any economy. You want to see that on balance, we have a large amount of positive net investment spending because this is how our productivity and standards of living will grow in the future. Now, here's something that people can get easily confused about. In economics, at least, we have to make a very important distinction between wealth and income. Wealth is how much you have right now in the bank. All right. So, as college students, let's say you have, I don't know, $500 in the bank, and you feel pretty good about that too. That is a fixed amount of money that you have at one point in time. But on the other hand, let's say you work part-time and you make $400 every month at your part-time job. That would be considered income because it's a flow. Every month you earn $400 more. So the income is measured as so many dollars per month or per year, but the wealth is a fixed amount at one point in time. So you would say you have $500 worth of wealth, but $400 per month worth of income. All right. So wealth, again, is just how much you have at one point in time. Income means how much money do you bring in over a given period of time.
Yeah, but doesn't income became like wealth?
Oh, absolutely. If you save some of your income, that is going to be added to your wealth. That's correct. Absolutely. But remember, wealth just means how much do I have right now? Income means how much do I bring in every month or every year? Okay, so the difference is one is we call it in economics, wealth is what we call a stock variable because it's the amount you have right now. Income is what we call a flow variable because it represents how much is coming into your pocket every month or every year. All right, anyway, now also we need to make a distinction between these two possible things that can happen when you own financial investments like stocks and bonds. Their value can go up and their value can go down. Okay, that's the risk you take when you own financial assets. A capital gain means that you bought an asset and the price has gone up. A capital loss just means that you bought an asset and the price has gone down. So if you have a capital gain, your wealth goes up. If you have a capital loss, your wealth goes down. So wasn't it somebody in this class who bought a Bitcoin a couple of years ago for a few $100s? Or was that another class that I'm teaching? I can't remember anymore. Somebody was telling me that they made a lot, and I mean a lot of money by buying Bitcoins. Well, it's what?
It was me.
Okay, so you made a lot of money. So you earned what's called a capital gain by buying the Bitcoin at a low price, and now it's worth a lot more money, isn't it?
Yeah, I sold it already.
It did sell it. All right. Well, congratulations. You put the money in the bank, I hope.
Yeah, I did.
So your wealth went up because you earned a capital gain. Congratulations. You did it. Okay. That's what all investors want to do. So keep that going and you'll be able to retire when you're 32.
Hopefully.
But you'll certainly be better off than if you lost money. So yeah, so it's hard to find those investments, isn't it? There's so much risk involved. This is the big challenge, finding investments and buying them before they gain in value. That's the big challenge that faces all of us. All right. So anyway, now we're going to be looking quickly at the markets for financial capital, which I briefly mentioned before. If imagine a business needs to raise funds in a hurry, you can get the money at a bank. You can issue stocks and you can issue bonds. By the way, in the United States, at least, you have to be a corporation to issue bonds or stocks, but any business can go to the bank and get a loan. Okay, so these are restricted to corporations. And of course, not all businesses are corporations. A corporation is actually a separate legal entity which shields the owners from personal liability. So if I start up a corporation and I'm selling, let's say, glow-in-the-dark smoothies, that's my big thing. My smoothies glow in the dark. So you buy it and you take it home and you drink it at night and it looks really cool. So let's say the idea never catches on and my company loses $1 million. I don't have to pay that $1 million out of my own pocket. All I have to do is declare bankruptcy and the corporation is dissolved, and that's it. I just walk away from the whole thing. So the purpose of a corporation is to prevent the owners from putting their own funds at risk. If everything goes wrong, you can just declare bankruptcy and walk away from the whole thing. And so corporations it's the ideal business structure for relatively large companies where the risks can be quite enormous. Okay, but only corporations in the US can issue stocks or bonds. So if you're not a corporation, it's going to be a lot harder to raise funds if you need them. That's when you have to rely on the banks or possibly venture capitalists. Anyway, the markets for loans are just what it sounds like. these usually when corporations need to borrow money, sometimes they just need it for short periods of time. Like let's say that your payroll is coming due on Friday and you don't have quite enough money to cover it. How would the employees react if you told them, sorry, we don't have enough money to pay you this week? Would that go over well? No, that would be a problem. So now, the thing about corporations is, the revenue streams may not be very predictable, or they may be inconsistent. And sometimes you just go through stretches where you don't have that much money. So you borrow to cover those types of short-term expenses. You borrow money to pay for the salary that's due, or the electric bill that's due, or things along those lines. These are typically very short-term expenses where you just don't have quite enough money on hand to pay them, but you expect to have it very soon. That's the key detail. You're not just saying, well, I hope I'll have the money one of these days. You're borrowing the money because you're temporarily short of what you need, and you need to fill that in very quickly. On the other hand, when you need to borrow money for long periods of time, of course, loan markets are not just for businesses. This is an area that individuals can get involved with too. In fact, some of you may have already experienced this if you, let's say, bought a car with a loan from a bank. Has anyone here ever actually done that? Not yet. That's all right. One of these days, you're going to want a car, and you probably won't have the money to buy it outright. Yes, you borrowed money to buy a car. And so, of course, it's because, well, it's a lot of money. A car is a very expensive investment, and you may not want to wait until you have the savings. So you go to the bank and you borrow the money. Of course, the trade-off is that you then have to pay interest to the bank. So the cost of the car will be more, or that too. If they offer you a preposterously low rate of interest, you may borrow the money even if you don't need it. It depends on what the interest rate charged is compared to what you could earn in your investments. That will help you determine whether you should borrow the money or not. Now, I've met people who have a real problem with borrowing money, and they won't do it no matter what the interest rate is. And, that's their decision. But normally what you try to do is just compare the cost of borrowing with what you could earn from your investments. And that's how you can make a decision whether or not you should borrow the money. So you can borrow the money not just to buy cars. Also, you might want to buy durable goods, which means cars or furniture or appliances. Suppose you just bought a new house and you need to fill it with furniture. Well, you can't wait. You don't want to wait till you have the money to buy that first, the desk or the chair or whatever. What do? That's right. If you bought a house, you almost certainly got a mortgage from the bank. The word mortgage means a loan that's meant for real estate or property. And in fact, interestingly enough, it contains, if you read that word very carefully, mortgage, the first four letters more comes from the Latin word for death. Or is it dead hand? Yes, because you're slowly killing off the loan in stages when you pay it off. Okay, so anytime you're wondering about the origin of any word, especially in finance, almost certainly it has a Latin origin. In math, words tend to have more likely to have Greek origins, but in economics and finance, the words that we run into often have Latin origins. But anyway, there's many different kinds of banks, by the way. It's not just your local savings bank. There's also commercial banks. Savings banks tend to make most of their money by issuing mortgages to individuals. That's where the bulk of their money comes from. Commercial banks make a lot of their money by lending to businesses, although savings banks can do that too. There's also what we call investment banks that make most of their money by buying and selling securities, not so much making loans to customers, but for example, buying stocks and hoping to make a profit from them, or they may perform services for banks or for companies by offering them the opportunity to sell stocks or bonds with what are called underwriting services. So there's many different kinds of banks out there. And in fact, you could dedicate a whole course to that. But the bottom line is what they're doing is they're taking the deposits of savers and turning them into loans to borrowers. How do they make their money though, a bank? Where's the profit coming from?
Charge you more interest than they pay.
That's right. If you've ever been in a bank and you've put your money in a savings account, what the spread, right? What kind of interest do they pay you on your savings? Well, let's just say it's low. In fact, maybe we should do a quick research here. What interest rates are currently being paid by banks for savings deposits? And we're going to find out really quickly. Well, here, these are supposed to be the best. Okay, look at these numbers. 0.5%, 0.4%, 0.45%. Is that a lot of interest? No. Look at some of these. Oh my God, this one is paying 0.05%. Some preposterously low rates. What do they charge you for, let's say, a car loan? Let's try. All right, let's see what we got here. Oh no, I wanted the numbers. Here we go. No, this is an ad. No. Here we go. Oh, well, you know what? This brings up an interesting point. This number, because it's a large amount of money, depends on your credit rating, which you'll learn all about this when you graduate. The credit rating tells how likely you are to repay a loan. And there's a number here that tells the bank how likely you are to repay any money that you borrow. A high score is a good score because it means that there's almost no possibility that you'll default on your loan. If you're down in this neighborhood, the risk is very high. So you can see the interest rates depend on what kind of credit rating you have. But let's face it, compared, no matter which rate you're charging the customers, this is still a lot more than you're paying on your savings deposits. So this is where the banks make their money. They borrow at a very low rate of interest by giving you a small amount for your savings account. And then when they lend money to customers to buy cars or other things, they charge a much higher rate of interest. Much higher. That's the magic word, much higher. And the spread between the two is where they make their money. Now, having said that, though, the one thing that this doesn't reflect, the bank, when they lend money, though, is taking on a risk. And they expect to be compensated for that. What risk are they taking when they lend out money to customers? What's the biggest thing they worry about? Yeah, not getting the money back. Just because you promised to pay it back, are you going to? Who knows? What happens if you lose your job? You know, all kinds of terrible things can happen to you that make it impossible for you to pay your loan back. And the banks know that. That's why they charge a higher rate of interest for the riskier customers, because they know there's a chance that they'll never get the money back. So in the meantime, they earn as much interest as they can to make up for that. Okay. So anyway, well, here's another place where you can get a lot of good information. This one, man, if you just are looking for a car loan for yourself, this is a nice little spreadsheet that lets you figure out, like, let's say I'm interested. Let's say this applies to me. And I say, oh, okay, I want to know how much you're going to charge me for a car. It's new. Let's see. It doesn't, you know, the thing is, it doesn't ask how much I want to borrow. That's kind of weird. I hope I'm not committed myself to something here. No, this is where you tell them. But if you look at these rates, new car rates, oh my God, those are pretty low. And look at, ooh, maybe I'll buy myself an Audi or a BMW. Oh, I don't even want to know how much these cost. All right, well, anyway, you get the idea. So what about the bond markets? Now, bonds are a specific type of financial security. You don't hear about them a whole lot in the media. They're just not that exciting. In fact, if you look at any investment TV shows that are on right now, they usually spend almost 100% of the time talking about stocks because stocks are exciting, they're fun, they're cool. Bonds are dull. In fact, has anyone here ever seen that movie, The Big Short?
Yeah, I've seen it.
There was a scene where they were talking about how in the 70s, the bond markets were considered to be the most boring part of the financial markets. If you were on Wall Street, the one thing you never wanted to do was get involved with bonds because they were so boring. But then a lot of innovation came along, and suddenly the bond markets were just jumping with excitement because there were so many different products to choose from and a lot of different ways to gamble on interest rates. So they went from being one of the dullest investments out there to one of the most exciting ones. And so they did mention that in one of the early scenes in the movie. Where they're talking about how this whole situation arose where suddenly people with no real income are buying houses and paying for them, hopefully in the future. So that was a very well done movie, by the way. And it did a very good job of explaining the financial crisis that hit in the late 2000s as a result of the bursting of the housing market bubble. But here we're looking at relatively safe bonds. Corporations issue bonds frequently when they need to borrow to raise money. Often borrowing money with bonds is cheaper than going to the bank. And also bonds are often issued to finance long-term investment projects. Like imagine that Coca-Cola has decided, you know what, we suddenly discovered that we don't have any dealerships in Morocco. And we decided that we're going to go ahead and invest a lot of money in Morocco to build up our presence there. That's going to cost $100 million. And it's a very long-term project. We probably won't see any profits for many years. That's not the time to be going to a bank because they'll need the money back fairly quickly. So instead, you issue these bonds to investors where what you're effectively doing is you're borrowing their money for a very long period of time. Typically for corporate bonds, that time frame is 30 years. What does the investor get from this? Well, in a typical case, let's say the investor decides to buy one of these Coca-Cola bonds. They'll pay $1,000 for the bond, which goes into Coca-Cola's pocket. And for the next 30 years, Coca-Cola will send in or make an interest payment to the owner. And after 30 years of interest payments, they will repay the original $1,000 to the investor. So you're lending Coca-Cola $1,000 now in exchange for 30 years worth of interest payments and a repayment of your investment in the end in 30 years. So this way, Coca-Cola doesn't have to pay you back your loan for 30 years, but they then owe you 30 years worth of interest. That would be a good way to invest in their Morocco operations because they don't know how long it'll take for that to become profitable. Governments also issue bonds, but remember, governments are not trying to make money. They are just trying to cover their deficits. Now, you know that in this day and age, governments always spend way, way more money than they bring in tax revenues. How do they cover the difference? They have to pay for what they're buying, so therefore they borrow it from the public by issuing bonds. Now, government bonds are a little bit different than corporate bonds in the sense that the bonds issued by the government are completely safe. The bonds issued by corporations are not so safe. They can be very safe, but with a corporation, there's always a risk that they could go out of business. And then the investors are not going to get the money they were promised. The government can't go out of business. So it's safer to buy bonds from the government than from corporations. But the trade-off is that government bonds will provide a much lower rate of interest than the corporate bonds. So as an investor, you have to make a decision. And that too, there are tax breaks associated with bonds issued by the federal government. As far as I know, they're not taxed at certainly not at the state level. I don't remember the exact details, but they definitely give you a tax break compared to corporate bonds. So there are a couple of good reasons to buy government bonds, except for that one little detail. The interest rates they pay are low. In fact, how low are they? I'm glad you asked. Let me just quickly show you what rates they're paying these days. There's a wonderful website here called Daily Treasury Yield Curve Rates. And what you're seeing here is, let's go. That's correct. Municipal bonds are issued by state and local governments. They may not take, let's say if you live and work in New York City and you buy a New York City municipal bond, you don't have to pay city, state, or local or federal taxes. That's true. Absolutely. But as far as these guys are concerned, let's look at this top row for a minute. So as of March 1st, now these numbers on the top are maturities. Treasury securities are offered in ranges from anywhere from 1 month to 30 years. You have a lot of choices here. But look at these interest rates. This is 0.03%. Okay, you have to go all the way out to 7 years before you get over 1%. Now that's still a lot more than your savings account, but it's still not a whole lot compared to other bonds in the economy. And then it starts going up a little more quickly. So at this point in time, you could get a 30-year treasury bond that pays 2.23%. Now, how does that stack up with corporate bonds? Well, let's just pick one at random. Let's think about, let's say, Apple bonds. All right, so here's a company called FINRA that keeps track of all this information. And if you want to look up bond data, you can go to this FINRA website. And, I think I'm lost. Here we go, Apple. Now, what they're going to do is show us a list of all the bonds that Apple has issued in the last so many years. Let's look at this one on top, 2.4%. This one below it, 3.85%, 2.85, 3.45. Well, you get the picture. This is significantly more than what we were getting from that 30-year treasury bond. Why are they paying us more than the treasury bond? Because even Apple, as inconceivable as it sounds, could potentially go bankrupt and will end up with less money without getting all the money we were promised. So when it comes to bonds, the interest rates that they provide us depend on how much risk is involved. Okay, now, in order to truly understand bonds, we need to look at a handful of key features that uniquely characterize each bond. First of all, when a bond is first issued to the public, the price, which we call the face or par value, is usually either $1,000 or else a multiple of $1,000, such as 10 or 100,000. If I buy a brand new bond, I'm going to pay $1,000 if that's the face value. And if I hold it until the maturity date, I'll also get my $1,000 back. Okay, so 1,000 is pretty normal, although some treasury securities have face values as low as $100. But for the most part, you can think of $1,000 as being the standard face value for a bond in the United States. The coupon rate. Now, this is a surprising name for this. The percentage of the face value that's paid to you in the form of interest every year is known as a coupon rate. Oh, there's that too. Yes, funds that only hold government bonds can have tax breaks as well. But anyway, just to get a feel for what a coupon rate looks like, Let's take a look at Apple again. And if you notice, these are the coupon rates, 2.4%, 3.85%. So if I buy this bond on the top and it has a face value of $1,000, that means every year they will have to pay me $24 worth of interest, because that's 2.4% of $1,000. So this number tells me how much interest they're paying me every year. Now, here's an interesting question. That's correct. The typical, in the United States, the standard practice is to not pay you $24 once a year, but $12 twice a year. I don't know how this happened, but when the coupons are paid, they typically pay you half of the full amount twice a year rather than making you wait until the end of the year for it. That's the convention in the US. Other countries are different, but in the US, the coupons are paid out twice a year. Now, as I was starting to say though, when have you, in what circumstances have you previously seen the word coupon? When you hear the word coupon, what do you normally think of?
A discount?
Maybe, or how about when you go, let's say the supermarket, and you pay for your groceries, what do they usually print out besides your receipt? They hand you other pieces of paper, and what are those? Well, what they do in the supermarket is they'll give you a little piece of paper and you look at it carefully and it says $1 off your next purchase of paper towels. What is that piece of paper referred to as? What's the name for that thing?
Coupon.
It's a coupon, that's right. Or you may be on their mailing list, Bed Bath & Beyond. What do they send you like all the time? They send you these little ads, and what's on the back? A little coupon that entitles you to 20% off your next purchase. So why are the interest payments on a bond referred to as coupons? What's going on here? I'll tell you what that's all about. This is for historical reasons. At this point in time, if I buy, let's say I decide to buy an Apple bond, what's actually happening? I have a broker, an online broker of some kind, and I get into my computer and I tell the broker, I want to buy an Apple bond. And then I pay for it. It's credited to my account. That's it. And every month I can look at my account and see how much it's worth. And when coupons are paid, they go right into my account. But historically, let's say 100 years ago, it didn't work that way because there were no computers. What did they do instead? Well, you were given a physical certificate like this one. Imagine yourself wanting to buy a bond issued by the state of South Carolina. This thing is way too small for me to read it properly, but I'm going to say, here it is. Oh, there we go. Beautiful. This was issued in 1873. If I wanted to buy this bond in 1873, I would have received this actual certificate, which proved that I owned it. And I would have been entitled to receive 6% interest every year for as long as this, until the bond matures. So in other words, I'm getting $60 a year in interest payments based on a $1,000 bond. I don't actually see the dates, but it was issued in 1873. Now, here's the question. How did I collect my interest or coupon payments? Well, if you look at this bond issued by the Pacific Railroad Company in 1895, what do we see at the bottom here? Oh, I can't scroll it down any further. Oh, I'm so disappointed. Oh, you could just about make them out. These little strips at the bottom What's going on down there? I unfortunately I can't seem to make it any bigger. Maybe I can find a better example. Well, here's one. This is a US, or any one of these will do. This is a bond over on the right, a $50 US Treasury bond that was issued, it looks like at the beginning of the 20th century, 1917, there it is. If I could only make it bigger. Oh, all right, we can see this one very well. This bond is worth $100. It's got 4.25% listed on top. So right here, if you can see, this little strip of paper has a date on it, October 15th, 1920, $2.13. What do you suppose that means? That on October 15, 1920, I was entitled to receive a coupon payment of $2.13. And what I had to do is take a pair of scissors and cut this off and send it, or take it to a bank actually, and I would have received my $2.13. That's how it was done, not electronically, not with a computer, but with a physical piece of paper attached to my bond. And you can see why these were called coupons, because they are coupons. Just like the ones that let you get $1 off from paper towels, these strips of paper were used to cash in your interest payments, and so they came to be known as coupon payments. How do you like that? Now, of course, at this point in time, these are, of course, no longer valid, but you can rest assured that a collector would pay a lot of money to own one of these certificates. So that's where the name comes from, coupons. They started out as physical coupons, and we still call them that to this day. So the coupon rate is the percentage, like on this one, remember it was 4.25% annually, which means 2.13% semi-annually, and that's the rate. The actual coupon is the dollar amount that you're entitled to collect, which in this example was $2.13 on a semi-annual basis. How do you like that? So that's where those names come from. And like I said, if you look again at this Apple chart here, this one on the top is paying 2.4%, which means $24. Typically, it would be split up into $12 twice a year. But you're not going to get a physical certificate. You're just going to get an entry into your account, your trading account, and that's it. That's how you'll know. There's no certificates. They don't have them anymore. They don't need them. Okay. Although I have to tell you, I read one day on the internet somewhere that for most corporations, if you absolutely insist on it, they will, for a fee, print you a bond certificate. If you really want one that badly, they will do it for you, but it's not going to happen automatically. So anyway, if you were to actually go now, you know, it's sad. There used to be a museum in Manhattan called the Museum of American Finance, and they had a massive collection of these historical bond and stock certificates that were really cool to look at. The only problem is the building was destroyed a few years ago by flooding, and they're still trying to find a new place to open up the museum again. So while we're waiting, we can't really see their collection. If they ever open up again, you may want to check them out. In fact, let's see if I'll put this in here so you can remember, look for this. You see in the newspaper that the Museum of American Finance is reopening. Oh, wait a minute. No, that was meant for everyone. Hold on. You should go check it out immediately because it's a very cool place, including all these historical bond certificates. In fact, here's one that they have that you might find interesting. This is going back to American history. Does anyone know what major event happened in 1803? That's all right. I'll give you a hint. How about the Louisiana Purchase? Now, you all know the story. I can't seem to make it any bigger here. Napoleon sold Louisiana to the United States in 1803. He needed the money to carry out his nonstop wars with England. So it cost $15 million, which was a lot of money in those days. The only problem was the US government didn't have $15 million. So where did they get it from? What do you think they had to do to get their hands on $15 million? They had to borrow it by issuing bonds. Borrow it, yes, but specifically not from a bank, but by issuing bonds that investors could buy. Now, interestingly enough, in the Museum of American Finance's collection, they actually had one of those bonds that was used to finance the Louisiana Purchase. So that's some serious stuff right there. The Louisiana Purchase was paid for with borrowed money. It was paid for with bonds. Interesting. And of course, it was quite the bargain, as you can see. It expanded the country size quite considerably. But, and the funny thing is, Jefferson sent his envoys to Napoleon in France. And when they went there, they were instructed to negotiate the purchase of New Orleans. Just New Orleans. And when they came back, they said, President Jefferson, guess what? We bought the entire Louisiana Purchase. I bet he was surprised. That was the intention, just to buy the port of New Orleans. And instead, they wound up with the entire Louisiana territory. Wow. And it was financed with bonds, government bonds, this was one of the first times the US government issued bonds to borrow money. All right. And then finally, the last thing you need to know about a bond is when it will mature. That's the date on which they repay your money and you stop getting coupon payments. Okay. So anyway, so we just have a few more things to say about bonds, and we'll start looking at stocks. And then we're going to switch our attention to a model that we'll use to help determine the level of interest rates in the economy. Okay, but in the meantime, I guess that's enough for one day. I think we had plenty of fun for one day. That's, you can only stand so much fun, right? So I think that'll be enough. And just remember, this is where coupons come from. So when you hear that word again, you'll be in the know. Most people don't know this. You'll be in the know. This is where the word actually comes from. Okay. All right. So unless there's any last minute questions, I will see you all next Monday.
Thank you.
Thank you.
Thanks. Have a good day.
Okay, you're welcome.
Yeah.
Bye. All right.